All right, guys, so today I'm just basically going to tell you how these renovation loans generally work, what I think you need to know. The reason why these are so important is because if you're going to buy a house and you want changes to be made to it, you're going to buy some fixer-upper or something that you want to do something to it once you get in. It's very hard if you have 3, 5, or 10% down payment, maybe even 15% down, to buy the house with your original loan and then go find a second loan to put on top of that afterwards, to take more money out of the house when you barely even have any equity to start with, because the lenders out there aren't going to want to fund that for you. They're going to see it as a risky loan, and you're not going to be able to fund all those repairs, having a low down payment. You're not going to really find somebody to play ball with you. So either you can take out a loan with all this extra room to pay for repairs, which is what these renovation loans do, or you can go the other way and try and take out a second loan afterwards. But basically, you go and make an offer on a house, you go under contract, you get an appraisal ordered, and you tell the appraiser what type of renovation plans you're going to want to do to the home. It's then going to come back with a as completed appraisal value. The appraiser is going to say what the home is going to be roughly worth after the renovations are done. And there's no dollar for dollar value improvement. If you put in some cabinet package in the house that really costs $40,000, the appraiser might not give you the full $40,000 worth of that. Appraisers have told me this stuff before. So don't think that everything that you put in is going to increase the home value by that amount. Now, if your appraisal comes back low, you basically got one of three options to do. You can cut back on the renovations to try and make a loan work. Number two, you can maybe get the sellers to change the sales price to try and fit some more renovations in there. That's if they're willing to. And number three, you can, instead of financing the repairs in, you can pay for some of those out of pocket after closing. But back to how these work, the plans got to have really itemized specific work that the contractor is going to agree to perform for the borrower. It's got to be stated, agreed upon costs of the renovation, very detailed. For example, how much is the landfill dump going to be to take out the old materials of the home? How many gallons of paint? How much to polish the cabinets? Every little thing you can think of. You got to have a very detailed schedule for completing each stage of work. Contractors all going to be licensed. Contractors must show all required insurance coverage for their work. And you really want to have some of these people already lined up before you go and make the offer on the house. So it's very difficult to, try and do all of this after the fact, after you've made an offer on the house. You kind of want to have these people nearby you when you're thinking of making an offer. Otherwise, it can be really difficult. You try and go under contract and then figure this stuff out after. It could all very easily fall apart really quick. But then the renovation goes like this. So by the time you close, no repairs will have been done. You can't make any repairs on the house until you actually have closed on it and gain ownership. So there's going to be a few months after you close where you're not even living in the home, even though you own it. It's not going to be ready to live in yet. It's not going to be habitable. We're going to hold an escrow account full of the renovation funds, and we're going to release those to the contractors bit by bit as they do the work. And this is aside from the optional escrow account we're also going to hold for you, that you're going to pay up front to fund the first few payments of the home. If there's any increase in costs during the renovation, well, that's going to have to be funded by the borrower. Your lender is not going to increase the mortgage amount for you after you've already closed. And because of that, the lender is going to ask for a cushion. This is going to cause other fees, independent consultant, management, engineering fee, property inspection, title updates, permitting costs, and at the end you move in. Now there's two main loans here. There's a conventional and an FHA. The conventional renovation loan is called a conventional Homestyle renovation. It's 3% down for first-time buyers, 5% down minimum for repeats. You don't have to do 3% down if you're a first-time buyer. You can do a larger down payment if you want. I'm just saying that's the minimum down payment. But the renovation costs on this one cannot be more than 75% of the improved or as completed value of the house. So for example, if you want to buy a fixer-upper at 300K, you couldn't add any renovations of over 900K on that, because any combined renovations over 900K would be over 75% of the final $1.2 million proposed home value. That's 300K purchase price plus the 900K renovations. That's over 75% there. But fixed rates only on this loan, no ARMs. Borrower can set up an escrow account for the first few up to 6 payments if they want, while the home is unlivable during rehab. So they just front money up front, so you don't have to make those payments every month for a few months. The loan to value is going to be equal to the original loan amount divided by the lower of, number 1, the as completed value that the appraiser gives it, or 2, the purchase price plus the renovation cost value. This loan, this conventional home style renovation's better for having a lot of equity in the property, and I'll tell you why in a minute. And then you have your FHA, what they call a 203K renovation. 3.5% minimum down payment here. You do have a 1.75 funding fee, just like all FHA loans have. It goes on top of the loan amount. It's a pretty big fee you can't get away from. You're going to be paying a consultant fee, inspection fee, totaling a few grand extra. The contractor must be FHA approved, not just licensed here, just like with the conventional loan. The maximum debt to income ratio, just like most other FHA loans, will most likely be 57%. That's compared to 50% usually is the common debt to income ratio max on a conventional loan, like the last one we covered, the Homestyle. Now, here's why this is much better than the conventional one, is because the loan to value ratio here, the maximum on it is 110%. It's crazy. Okay, you basically get to buy a house. Let's say you bought a house for 500K. You could then get a loan on it for $550,000. That's like 10% more than what the home is even worth, okay? If you're buying a house 500K with that conventional renovation option, you can only get a loan amount of up to $485K. That's $65,000 difference just for that one example. My opinion, conventional is more flexible. It has better terms than the FHA 203K renovation, but it's just harder to do that conventional loan option with a lesser down payment, because if it underappraises, you got to cut back on improvements. If you have at least a 10 or 20% down payment on this conventional one, you can have it underappraised and still probably have enough equity to still finance your renovations. Both the FHA and the conventional here are, I think, great for small to moderate renovations. If you have a 500K house, you want to, finance in 70K to 100K to redo the kitchen, the floors, the cosmetics, windows. This is great for that. Full teardowns on a house, if you want to add extra rooms, get extra permits for that, do a complete gut job, it's going to be tough. You'd probably want to leave those to the actual home flippers, these people that buy these homes in cash and have money to finance it, maybe with a side small loan that's just going to be temporary, and then they put it on the market as a turnkey house, and it gets back to you. That's really how most of these renovations are done on the market. There's a ton of home flippers out there, and they're always looking for deals, and it's usually way easier for them to do all this stuff than for you to try and get all these people together. Unless their agent has some crew that they typically work with on these renovation deals, it's tough. One more thing, the rates are typically higher here versus than a resale conventional or FHA home loan rate would give you. Now, you can always customize your interest rate, just like in the video here. Very popular video for me. Not sure why, but you can always pay more closing costs to bring the interest rate down. There's always some give and take there. But to figure out if this is right for you, you want to compare the renovation loan financing to the first trust financing, and then doing all this extra work on your own with either paying for the repairs out of pocket yourself in cash or getting a second HELOC or second loan. So it all depends. Every situation is going to be different out there. But guys, I hope that made sense. Hope you're already subscribed to the channel. If you're not, please give me a sub. I'm going to be explaining a lot more very important mortgage topics and concepts on this channel. And share this with a friend that you think would be interested in buying a house next year. Other than that, thank you very much. I'll see you on the next one, guys.